Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark comments on the biggest economic stimulus plan ever. Kaiser research founder John Kaiser says Trump, win or lose, will affect gold prices. And Viscount Mining Executive Chair Kaare Foy discusses the role geopolitics plays in mining investment. We'll talk to Ross Clark right after this.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure to be with you, Jim.
European Central Bank has launched its biggest quantitative easing program ever. Has it made a big difference in the equity markets?
Well, yes, it's made a difference in the equity market. There was a knee-jerk reaction on Thursday when the ECB made these announcements. I mean, clearly, everybody was expecting there would be something from Mario Draghi, and he did not fail to come through. As a matter of fact, the cuts, the amount of stimulus, as they say, is at record levels. And at the end of it all, when the markets had initially reacted, then he said, and there won't be any more. However, it's as far as these officials are concerned, we tend to find many denials before, the next event happens. So I wouldn't be surprised, and groups like PIMCO are saying that they wouldn't be at all surprised that this may even become the purchase of blue chip equities somewhere down the road. So they will do whatever they have to do at this point to continue to stimulate the markets, hold everything solid. And it did have that impact. Thursday in New York, markets came back quite well after an initial sell-off, and then on Friday they extended well to the upside. The Dow up over 200 points, the S&P up 32, and the Toronto market doing well as well. So it's clearly they are getting action in the marketplace based upon the effort that they're putting forward right now. And we know that each one of these stimulus packages, whether it was from Europe or China or Japan or the U.S., do have a spillover effect for a while. And we've seen things such as like the credit spreads, which we mentioned last week, have been narrowing in. So they made another significant move this week, in particular the last Thursday and Friday. The moves there were very big, so it's now the best narrowing of those credit spreads that we've seen in about a year. And with that, you then see all of these high-yield products, the bonds, which have been really decimated for the last year and a half, having their best 2-week run that we've seen in the better part of 2 years. So we've gone from this risk-off attitude in that January-February stretch where the markets put in the double bottom to back into a risk-on attitude. And when we take a look at the seasonality, we take a look at the election year characteristics, typically, as I said, you were going to have that late January, early March bottom in place, and we would expect now strength through the end of March into at least the early part of April.
Gold, now it can go in two directions right now. If the equity markets continue to go up, we expect the price of gold to go down. But what if there's a major drop in equities? What happens then?
Well, the drop in equities, if it all depends why the drop is happening. If it is because of concerns on the credit side, then yes, you probably see a bump up in the gold. There are some cautionary points that I see out there in terms of the gold market right now, though. The commitment to traders numbers, which have been getting up into high levels, as of Friday, the report there now shows that the commercials have greater short positions now than they had in the summer. It's getting back close to the levels that we saw a year ago. The speculative longs, likewise, back to the levels of a year ago. So any lack of momentum here, any negative news related to gold, and you probably see a sell-off just feed upon itself. The other thing we had here was back on March the 1st, the golden cross, that was when the 50-day average crossed above the 200-day moving average, and typically the market will, in gold, at least put in an interim high in the next 8 to 15 trading days. We are now well into that. I think we're 9 trading days as of the end of the week. So an interim high here in gold would not be at all a surprise.
Ross, anything else you wanted to toss in for this week?
Just the other factor would be the Canadian dollar and the oil markets. As we mentioned, those are getting up now more towards resistance levels, and wouldn't be surprised if they started to roll. And I would say for the Canadian dollar, first week with a lower low, and you'd expect to see it give back maybe 60 to 80% of the move we've had up from the beginning of the year. So that's food for thought for the investors for this week.
Ross, thanks a lot for chatting with us.
All right, Jim.
My guest has been Ross Clark, Investment Advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, John Kaiser on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Kaiser, founder of Kaiser Research. His website, kaiserresearch.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, John.
Jim, it's great to be back on the air with you.
Well, you had a busy week. You were in Toronto at the PDAC, the Prospectors Developers Association of Canada conference. What was the mood there? What were people talking about?
Well, people were feeling a different vibe than in the past couple of years. In the past couple of years, there was all this talk about, it's time for bifurcation. The good stuff is going to separate from the bad stuff. It's time to buy. And in the last 2 years, we had a decent gold-driven rally in the first quarter, and then after PDAC, of course, the gold price failed, and everything went into hell in a handbasket. And so one would think third time around this is going to happen again, and people should be a lot more cautious. But this time there's something different going on. This time the mood isn't just clinging to the gold price rally that has happened since the start of the year. It was a good mood. It was the lowest in probably 6-7 years at 22,000 attendance. That's down from 23,500 last year, and that's down from about a 30,000 peak in I think 2011 when everything was still going gangbusters.
Why the decline in attendance?
Well, we are now theoretically in the 6th year of the worst bear market to afflict the resource sector in many, many decades. Usually you get, several years of a down cycle. The problem this time around, we're dealing with the back part of the super cycle that kicked in 2003, and that essentially peaked in 2011. And so we've had major mobilization of mine supply by the mining industry. China's growth trajectory has slowed down, so we have an imbalance of supply and demand for raw materials. We've had stuff overbuilt, and so everything's we've got a global slowdown in the economy. So everything is sort of coming together to do the usual boom bust thing, except this time it's not just the business cycle boom bust consequence, it's the super cycle boom bust consequence. And so money has fled the sector. There's pessimism about how long it will take for raw material prices to go up. And yes, we've seen the declining attendance as a result, because if you've been in this space and had exposure, you have generally lost money.
What exactly is a commodity super cycle?
Well, in a business cycle is when you have an economic expansion because interest rates are low, and the mining industry always lags because by the time they make a decision to put a new mine into production, it still takes 3 to 5 years to do it. And so the decision to put mines into production is triggered by, metal prices are high. They don't seem to want to come down. We have big profit margins staring in our face, so let's do this. But of course, high prices signal inflation, so the monetary the central banks apply their monetary policies, raise interest rates, which put a damper on the business cycle, and a recession kicks in just as the miners deliver new supply to the market, and there you get the supply-demand imbalance. A super cycle is when it isn't just a normal business cycle. It's when something unusual happens, such as a country like China, stuck in the rut for many, many decades, suddenly breaks loose and goes on an expansion tear where you have an order of magnitude increase in demand for raw materials, which has nothing to do with the business cycle. It is a structural thing, and that was China unleashing all the people in the hinterland, migrating to the coasts, liberalizing its business rules, becoming kind of a capitalist communist hybrid entity, and becoming a manufacturing juggernaut, and sucking up raw materials to build infrastructure, to build productive capacity. And that's a super cycle. They do not happen very often. There was one after the end of World War II, and this was the China one. And the hope is that, India is the next big hope, but India is only 2% of the global economy, is a hidebound bureaucracy. It's probably 2023 and beyond before India can reach that tipping point that China reached in 2003. Once India works its way through this, it has the best demographics in the world. It has the second largest population base. And because it is a democracy, it could flourish in a way that China can't, because China is still in a democracy suppression mode, and that's ultimately going to really cramp its ability to become that big empire that they aspire to, and which everybody in the West is hoping will come along so that they can sell all kinds of goods and services to China.
Going back to the Toronto conference, what is the PDAC curse, and does it look like this year could avoid it?
Well, the PDAC curse is something I coined, and I tracked the 30-day average traded price on the TSX Venture exchange, which just dominated three-quarters by resource companies. And I've been going to the PDAC for, decades, and it was always, first quarter is always a good rally. It's always exciting. PDAC is the big celebration. We all congratulate ourselves. We party. We look forward to things getting even better in the rest of the year. And a couple of weeks later, it's like the sell in May and go away philosophy kicks in, and everything starts to go down. So I've plotted this on a graph, and sure enough, you can see a distinct peak right around the PDAC, and then it goes down usually for the rest of the year. There have been 3 violations in the last 15 years. The first was in 2003 when the China super cycle started to awaken, and that's when suddenly base metal prices started going up. Then 2006 was the second violation, and that was when the miners realized that the China super cycle was real. They'd been forward selling copper, nickel, and everything, and leaving enormous piles of money on the table because they thought, China's just a flash in the pan. We better forward sell all our production and take advantage of these fools who are willing to buy futures at these premium prices. So that's when they really got behind the cause of spending money, acquiring companies, developing mines. And the third one was in 2009 when we really thought we were kind of dead in the water after the crash of 2008. But quantitative easing kicked in. China said we're spending $600 billion on infrastructure to keep ourselves from falling apart in the wake of this crash. And we had a phenomenal run from 2009 to 2011. And since then, it's been negative all the time. This year, I think the PDAC curse will be violated. Yes, we do have a strong gold rally, the best gold rally in a very long time. That is pulling the market up. But there's also a distinct possibility it will fail just as it did in the past couple of years. But this time there's something different. There's a different mood. Companies have realized that substantially higher metal prices, especially in the base metals, are not in the near-term cards, and gold is fickle. And what we really need to do is find deposits, make discoveries that work with the metal prices that we have. And so we're starting to see companies coming up with results to which the market is actually responding positively.
Are there any bullish signs for resource stocks on the TSX Venture Exchange?
There certainly is. On December 31st, I published a new edition of my bottom fishing list, 100 companies. There's, about 900 companies have negative working capital. They owe about $2.5 billion. That's never going to be paid back. And then there's about 500 companies that still have $1.5 billion. So these so-called zombie companies, they've been sidelined until they fix up their balance sheets. They're not going anywhere. So what we really have seen is kind of like a massive culling as a result of this bear market, and it's made it easy to see who are the real companies, who have kept their treasuries, their balance sheets intact, which ones still have interesting projects, which have plans, work plans to do something with it. And this group, this 100 group, is up 40% from their base price at the end of the year. And by the way, in the first 2 weeks of this year, it was the worst opening across the board for all equity markets ever. And these things even went down. You could have bought them even cheaper than what I priced them at the end of the year. So that is quite interesting. And this is not a list that's loaded with all these ounce in the ground type companies, that are now being taken over. A lot of these are what I call more discovery exploration oriented companies. And that to me is a sign that this time the audience is not just buying optionalities, it's also buying what the Canadian juniors have always been famous for, namely the ability to make new discoveries.
Could geopolitics play a role in the supply and demand equation for base metals? And how does the base metal supply and demand look like right now?
Well, two questions. One, we talked earlier about the commodity cycle, which is basically driven by macroeconomic forces. And we are now in a very weak spot. I sat in to most of the commodity talks on Sunday at PDAC, and except for zinc, the outlook was fairly dismal for the base metals. We have oversupply in the system. We've got a lot of metals such as nickel and copper in the warehouses. It's going to take a while to draw down those stocks. We have uncertainty about where the global economy is going. There's talk about, Larry Summers' secular stagnation idea that we will have very weak global economic growth. We also have this problem in that the decline in metal prices has really crimped the ability of many of these emerging market economies who are significant raw material producers from continuing to purchase goods and services from places like China, which in turn, of course, reduces China's ability to grow. So we have a bit of a vicious circle at play, caused in part by the decline in raw materials. So what I'm suggesting is, macroeconomic forces will probably take several years before they are properly lined up again, and we do not have a super cycle type situation at play. However, we do have a security of supply type problem where some of these places that are dominant in producing raw materials, such as, say, China with rare earths and tungsten, antimony, and even zinc, perhaps something will happen that will result in this material no longer being able to be shipped to the rest of the world. The Congo with copper is also an important. Congo copper is very high-grade copper, so it's a very profitable form. But Congo itself is suffering enormous stresses, and if it implodes, such as it did in the mid-90s, we could see cobalt and copper supply, cobalt supply especially drop, and copper supply, lose maybe 5-10%. And these type of sort of random, unpredictable disruptions of supply could give the metal prices an unexpected boost. And I think that the next big game for the institutions is not so much bet on supercycles such as they did in the past decade, but to focus on the security of supply type of disruptions out there. And then again, with the oil situation, everybody's lamenting the weak oil prices, which is harmful for American shale production, Canadian oil sands production. But the Middle East is turning into such a mess. Saudi Arabia is the cause of this low oil price problems. What if we get some sort of accident in the Middle East, which takes Saudi Arabia offline, and all of a sudden 10% of oil supply is gone, and we're back to over $60 a barrel. Canada and the U.S. are back in action. A lot of these other countries that are oil producers are back in action. So these type of geopolitical things could provide unexpected boosts in the metal price trends ahead of what they would do in normal macroeconomic terms.
Geopolitically, what are the safer countries for resource companies to do business in going forward?
Well, I'm arguing that one should start looking at projects that are based in Canada, the United States, Australia, then you start maybe a little bit riskier, Mexico, Chile, Peru, and of course Argentina has been a great place to explore, but with the government that they had and their debt default and some of the crazy royalties that were imposed in provinces like Santa Cruz, with the recent government change, Argentina is opening up again. They are doing a deal on the outstanding debt holders. So that's a country that's going to be interesting again. And of course in Africa, I'm very concerned in northern Africa about the rise of the jihadis infiltrating all these areas. The countries there that I think are probably still very stable are Botswana and places like Ghana. South Africa I'm not particularly keen about because I see enormous civil stresses emerging in that country also. So again, although deposits in places like the United States and Canada don't tend to be as high grade as in some of these more exotic places, if you sort of lean towards my idea that this idea of globalized trade is probably on the rocks and could suffer some serious geopolitical shocks down the road if, say, China, United States end up in a standoff over the South China Sea or over North Korea's shenanigans. We should be able to look at companies that are tackling lower grade deposits in safe jurisdictions where there can be long-term supply. You don't have to worry about shipping it from unstable parts of the world.
Exploration juniors strive to make a discovery. What do companies need to find for it to be deemed a discovery?
Well, of course, grade and tonnage are what determine the economics of a project. One of the problems that we face now in the exploration industry is that back in 1980, when gold went up from $35 and stabilized at $400, within like an 8-year period, that was a 400% real gain. And after decades of gold stuck at $35, even though inflation rose costs and the low-hanging fruit was harvested by the mining industry, by the time sort of the 70s rolled around, it was a lot of very high-hanging fruit. That became low-hanging fruit in 1980. The mining industry added 2.5 billion ounces to the 3.2 billion above ground stock that existed in 1980. But if you take $400 gold and inflation adjust it using the US CPI to the present, that's about $1,200, which is sort of roughly where gold is now. So even though we say, wow, gold's up 300% since 2005, we should all be happy as hell. Well, in fact, we're not, because we have harvested all the low-hanging fruit, and it is, even at $1,200, high-hanging fruit. So the miners, the explorers, now need to find even better stuff, and they need to go deeper. They're obviously not going to find anything left on the surface. They have to go after blind targets. They have to rethink existing systems that do not work with the metal prices that we have, on which they spent tens of millions of dollars doing economic studies, and now it's obvious we need $1,500, $1,600 gold in real price terms before this is economic. But one of the big things that's happening now is the companies, the geologists are going back and they're saying, do we understand this system? Is the metal budget that we can infer from the alteration footprint and the scale of this thing fully accounted for by what we have documented through our resource estimates? And if not, where could the metals have ended up and possibly be concentrated better than was the case what we found? And if you can come up with an idea such as Robert Friedland did back in 2003-04 when he bought Oyu Tolgoi from BHP, which is an open-pittable, low-grade resource that wasn't really worth anything at the metal prices back then, and he put his geologists to work, and they did geophysics and that, and they came upon the deeper, blind Hugo Dummett zone several times bigger and the grade several times higher, and now a world-class mine operated by Hugo Dummett. This is the kind of story now that the juniors are looking for, and it's exciting because it means, great geologists doing some clever thinking and then raising risk capital, making a case, give me money, let me drill these targets. If we hit, well, then we have something new that'll keep us busy while gold does whatever it does in the meantime. If it doesn't really pan out, so what? We still have this optionality of these lower grade ounces that don't work, but if gold does go to 1,1800 or so, well, then we get a bang for those ounces. And the most recent example of that was Probe Mines with its Borden discovery. Initially, 5 million ounces out 1 gram, but by the time 2014 rolled around, that was worthless, but they kept exploring. They found a high-grade underground zone. They got bought out for Goldcorp for $500 million last year. This is what people are now thinking about, and this is what I think will enable the sector to survive another stall in the price of gold.
Is it tougher now for junior resource companies to find a discovery deposit at current metal prices?
Yes, that is my point, because, there's a lot of exploration work that has been done in the past 30 years since gold first woke up. And again, when you inflation adjust these prices, there's no easy pickings left. So yes, you need to find better stuff than what has been found before, and it's typically going to be blind. You're going to need new exploration methods, like say groundwater geochemistry in Nevada to look for deposits that are hidden under the sands, or in the Athabasca Basin, radiogenic lead isotope clay sampling techniques that help you see high-grade uranium deposits 600 to 1,000 meters deep. And also a lot of sophisticated multi-data set integration techniques using all the digital computation that's now available and that the miners, the explorers, have just started to harness. It's like there's so much data out there, but nobody has really spun and manipulated it sufficiently on a scale needed to see, here is where the hole is, where a drill hole has never gone into, and this is where the juice could have ended up. Let's poke a hole in here. And then if you get it, well, then you've got a discovery delineation play.
Is Donald Trump good for the gold market?
Well, Donald Trump is a scary person in that nothing that he says makes any rational sense. And one could say, wow, if this man becomes president, geopolitically, the world will become a very uncertain, unstable place. And I've always argued that, talking about the fiat currency debasement and hyperinflation and that as a reason to get excited about gold, that's a bad idea for the miners and the explorers, because that type of increase in the price of gold drags the costs right along with it, and the high-hanging fruit stays high-hanging fruit. But if the world becomes anxious about geopolitical stability, about the status quo and so on, gold is an excellent place to park your capital, because once you own physical gold, it is stored energy. You cannot easily make more gold. The mining industry makes 80 to 100 million more ounces a year, but that's like a tiny 0.5% increase. And because of the cost needed to mine these available higher hanging ounces, all this low grade stuff, you need a higher gold price. So yes, Donald Trump will be good for gold because the world will freak out and want to hedge against all the crazy things that he could potentially unleash. The one thing I would say about Donald Trump, though, I think he is a performance artist who's actually satirizing every bad idea that the Republicans have nurtured for the past couple decades by taking them to their logical extreme. I think he is not a real person, that inside he probably doesn't believe a single thing that he says, and he's making a mockery of this stagnation, that this bipartisan stagnation that has crept into Washington and prevented the United States from properly dealing with the consequences of the financial crisis in 2008. And I think he is shaking things up and probably has no intention of being president, or if he did become president, he will get rid of all the nut bars that support him and probably become a much more rational person. And you have to keep in mind, the president is not a dictator. They still have to use the House and the Senate to get things done. And these two bodies are not going to let Donald Trump do crazy things.
John, how can people find out more about Kaiser Research?
You go to the website kaiserresearch.com. You do a first-time registration. I now have a deal where you can just do for $100. You get 30 days access to everything. It's non-renewable, non-automatic renewal. Log in. This bottom fish edition is fantastic. I think 40% gain that it's registered is just the lift-off from the bottom. If I'm right that the PDAC curse is violated this year, that we're at the beginning of a new cycle for the resource juniors that will run several years. Now is the time to look at this stuff, sift through it, pick your favorites, make sure you're diversified. Do not go all in on one of them. And there's also progress being made within the regulators. Even Ontario now has the existing shareholder exemption. If they can get rid of the existing shareholder part, then we can have a broad pool of retail investors putting money directly into treasuries. And because of the $15,000 a year limit, they are forced to diversify, which is what you absolutely have to do in this sector. It's high risk, high reward. You cannot count on the one stock you put money on that it's going to give you the 5 to 10 bagger that these types of juniors, when we get into an exploration, discovery-oriented type market, are capable of delivering.
John, thanks a lot for being on This Week in Money again.
Jim, it was a pleasure. Thank you very much.
My guest has been John Kaiser, founder of Kaiser Research, the website kaiserresearch.com. Coming up, Kaare Foy, next on This Week in Money.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Kaare Foy, Executive Chairman of Viscount Mining Corporation. Their website, viscountmining.com. You can find them on the TSX Venture Exchange. Their symbol, VML. Kaare is speaking to us from Vancouver. Welcome to This Week in Money, Kaare.
Thank you, Jim.
The Venture Exchange, for the longest time, has been beaten up. Why is that, and why is it finally back in the green again?
Well, Vancouver is a mining company, and most of the corporations listed on the Venture Exchange are mining companies, particularly involved with precious metals. So they've been hammered with the corresponding decrease in the price of silver and gold. Now that's just starting to show some signs of improving. So the response to the share price is showing improvement as well.
Viscount Mining's on the newly released Venture 50 for 2015. What is the Venture 50?
The TSX Venture 50 ranking is comprised of companies from each of the 5 industry sectors that comprise the TSX Venture Exchange. That is mining, oil and gas, technologies, life science, diversified industries, and clean technology.
How many companies in the Venture 50 are in the resource sector?
10, and we believe we finished third from the top, covering the whole of Canada.
What do you have to do to achieve the top 50?
Rankings are based on 3 equally weighted criteria during the year 2015, namely market capitalization growth, share price appreciation, and trading volume. All of these companies on average delivered a return of 77% for 2015.
What did Viscount do to make the top 10?
Well, we've been spreading the gospel on telling everybody about our project in Colorado, and more particularly our Cherry Creek project in Nevada. Viscount share price rose from 16 cents at the beginning of the year to reach a high of 63 cents in November. So with only 36 million shares on issue, it has traded more than 22 million shares in the past year, more than 60% of its register.
Kaare, can you tell us a bit more about Viscount Mining and its projects?
Yes. Viscount is a gold and silver exploration company with a portfolio of gold and silver properties in the western U.S., including Cherry Creek in mining-friendly Nevada and Silver Cliff in Colorado. Cherry Creek is comprised of more than 9,000 acres and includes more than 20 past-producing mines, largely on patented land. Also included is our Flint Canyon property in an area that exhibits alteration and mineralization characteristic of the Carlin-type gold deposits. Jasperite occurrences in Nevada are extremely significant in connection to Carlin-type gold deposits, and mineralized jasperite outcrops are common throughout our Flint Canyon area, similar to those in the large nearby gold deposits of Newmont Mining's Long Canyon and Barrick Gold's Bald Mountain deposits. We entered an exploration earn-in agreement with Sumitomo Corporation covering the Cherry Creek and Flint Canyon properties, whereby they can earn up to a 75% interest in the property by producing a bankable feasibility study, and in addition by spending a minimum of $10 million in exploration and development expenses by the 8th anniversary of the earn-in agreement, which was almost signed exactly a year ago. For Sumitomo, we estimate this will be a total expenditure for them of between 40 and 50 million. One of the fortunate aspects is that we have signed a head contract with them that permits us to put our property to them at the independent valuation contained in their bankable feasibility study. So rather than us continue thereafter as a junior partner, we can have them buy out, and that's the plan. That's plan A, buy out our interest at the independently valued figures.
Before joining Viscount, you were with Great Panther Silver for more than 18 years and its executive chair. When you moved, at the time, the company was worth $600 million U.S. What made you to switch over to Viscount?
Well, I'd just retired from Great Panther Silver and thought I'd take a breather, having been with them, yes, you're right, for more than 18 years, and very happy for the shares to have hit $5 US and to have reached a market cap of $600 million. An excellent effort by the team at Great Panther. And but I was suggested that I join Viscount by some mutual friends, and I decided to have a look at it at least. And the main reasons I decided to become their chairman was, one, it's increasingly important for mining companies to be in friendly jurisdictions in which they wish to operate. And Nevada is one of the world's most friendly jurisdictions. Secondly, I met Viscount's president and CEO, Jim McKenzie, I was particularly impressed with how he had been able to cobble together so many previously producing mines all onto one large property. And as soon as I saw the gold and silver grades being discovered there, such as publicly reported grab samples of 76 grams per ton of gold and 8,700 grams per ton of silver, well, that was pretty much the clincher. And in addition, I'd met a number of the directors and advisors, and was very impressed with the caliber of the people that Jim had brought to the company. So that was it, and I've very happy I did. We haven't looked back.
The people you work with are so important, aren't they?
Oh yes, and we spend most of our conscious life working. So I think it's vital to have people that you respect, that you like, and that you can have fun with.
What makes Viscount different from so many other junior mining companies?
Well, most equity investors buy shares in public companies, and if the companies are successful, the shares go up, and the investor sells those shares for profit. So they get back their money and their profit, but they no longer have their shares. And that is not the game plan for Viscount. Our plan is to find exceptionally rich properties that have been overlooked by major players for one reason or another, such as property ownership being seriously fragmented, etc. Then to remedy that defect, such as cobbling all the mines together onto one large property. to then demonstrate the potential of the property and to invite a major to earn into the property, i.e. that is to repeat the Sumitomo Cherry Creek situation. And then to accept a worthwhile offer from the major for them to acquire 100% of that particular property, not of the company, just of that particular property. Then to dividend out the proceeds of the sale to shareholders while leaving each shareholder still in possession of their original shares, which of course may also increase in value as a result of the company having been a dividend payer, which is very rare in the junior mining industry. This gives each shareholder a double whammy upside, cash in hand while retaining his increasingly valuable shares. And then repeat the same thing again as we are in the process of doing with our Silvercliff property, and then we go and look for property number 3, which in fact we have now identified, and in the process of looking for property number 4 to repeat the whole exercise.
How important are geopolitical considerations when you look for a prospective property?
They are very important and becoming more so. A change of government, a change of attitude, local governments permitting restrictions can cost a company a lot of money and can crucify the project, can even crucify the company. So it's vital, and that's why we are very particular in wanting to operate in well-established, friendly mining jurisdictions that have got a stable track record of being supportive of the industry. And certain parts of Colorado qualify, and most of Nevada qualify. And those are the 2 states in which we are focusing.
I guess Barrick.Gold's Pascua Lama property down between Chile and Argentina, the prime example of what happens when geopolitics goes sideways. An $11 billion loss.
Yes. It's a difficult problem and difficult to deal with. I mean, you can have great experts that come in and study the topography, the geology, the geography, that take samples and drill and can give you a very good handle on the property you have. But if you don't have the support of the government involved, then that can undo the whole thing. And it's not just necessarily one level. You've got the federal government, the district governments, the state governments, and you've got the local, in the case of Mexico, local ejidos. And if they're not all on board, then you're on a hiding to nothing.
And I was going to say, too, in a place like Mexico, the development fees aren't what we would call development fees. We would call them bribes.
In some cases, and one has to be very, very careful to make sure that we play the game, that we get the result, but that we adhere rigidly to the codes of conduct that are expected of us, either by law in Canada or by our own chosen levels of ethics.
Some people feel Canadian mining regulations might be overdone, might be too tough. Do you find them that way?
Again, it depends on the jurisdiction. In some cases, yes. I sit on another board in Europe where the investment managers look very carefully at the geopolitical impact, and particularly that of local indigenous people. And if it looks like there's going to be a battle to make things happen, then you simply don't invest there. You go invest where there's not a likely battle. You'll have enough problems in areas that appear to be friendly without having to go and set yourself up for a battle at the very outset.
How important is it to get to know the local people first?
I think it's very important because they have a view, and that view should be respected, and it affects them. One of the big problems is, first of all, not just doing what you think they would like, but asking them what they in fact would want. And then we've discovered there's even situations where they tell you what they want, but in fact that isn't what they really want. There have been instances in other countries where the well-intentioned, highly honourable mining corporation built a school on the property for the children of the local people. You'd think that was a lovely gesture. But the locals did not appreciate that, because when their children became educated, they took off for the lights of the big city, leaving the older parents with no one to farm their land, and that was to be their retirement package. And all of a sudden their superannuation disappeared over the hill and went to the big cities, which would not have happened had the school not been built. So there's an example of good intentions backfiring. So you need, so you need to ask the people, what do they want, and then go beyond them telling you what they want to find out what in their heart of hearts they really do want. And a lot of it comes down to, of course, self-respect, as well as the logical commercial advantages, their own self-worth, their own self-respect, and mining companies need to understand their different cultures and different needs, and to try and find out what their needs are.
Corey, how can people find out more about Viscount Mining?
Probably best to, keep an eye on the press releases, but the best is to go to our website, viscountmining.com. It is most informative. It lists the last 20, 30 news releases that have gone out, and it should be fairly self-explanatory. We're very excited to be working with a firm that's big and ethical and competent as Sumitomo, one of the biggest companies in the world, and we find they're just a delight to deal with. We're looking forward to a new, fresh drill program as soon as the snows melt, and we'll start in the early spring, and we hope to come out with even more bigger and better drill results on the back of, we hope, an increasing gold and silver price.
Corey, thanks a lot for being on This Week in Money.
You're welcome, Jim. Thank you.
My guest has been Kaare Foy, Executive Chairman of Viscount Mining Corporation. Their website, viscountmining.com. You can find them on the Venture Exchange under the symbol VML. That wraps up our show for this week. Thanks to our guests, Ross Clark, John Kaiser, and Kaare Foy. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.